time to sniff. That was fun. How on earth is the answer to this question 641? The depreciation, there's no depreciation in the land. The 200,000 is for the building. 39 years. Okay, yearly depreciation for a building is 200,000 divided by 39. So 5,000, blah, blah, blah. However, it was purchased. Okay, so it doesn't matter when it was purchased. It matters. It was placed into service. Oh, I'm an idiot. Because, okay, mid-month convention. I'm trying to figure this out. What? I misread the question. I thought that it was disposed of on October 2nd, but no, it was placed into service on the 2nd. So, what am I supposed to do here? Mid-month. So for year 1, you do start that amount, and then for year 2, it was disposed of on the February 27th. So that means your depreciation is only 2 months, or it's 1.5 months. So this times 1.5 divided by 12, 641. I'm such an idiot. I misread the question. You've got to be kidding me. I misread the question. And then the other one I got wrong in the quiz yesterday was this. So apparently in the 7th year, that's the final year. Like I was thinking, oh no, that's not the final year, because if you dispose of it during the 7th year, the depreciation doesn't fully apply because no, it does. It's the last year. I didn't think of this correctly. No, I was correct. During the 7th year, my thinking was correct. I don't know why I answered false. What? No, actually, what I was thinking on the quiz was the 7th year is the last year, so if it's disposed of in the last year. No, it's only if you dispose of it in the year after the last year, because if you dispose of it during the last year, it doesn't take the full year's depreciation, but if you dispose of it the year after that, then its depreciation is fully depleted, or taken, or whatever. The correct answer is 7th year is still being disposed of before it's supposed to be, or before the end of its depreciation. So you do multiply by 50% there. And that's all I got wrong in the quiz. Anyways, stop. I don't know. Stop. I'm going to go through the list of stuff to study for, and choose the ones that are the most important to study. Depreciation rules. Now, thankfully, I should be good on depreciation rules. Depreciation, because I recently studied that. Well, it was like 2 weeks ago. Section 1231. I just recently read about that. Like, I could probably skip studying for Chapter 11 because I just studied Chapter 11 yesterday. Accrual and cash, I definitely need to study that one. Types of audits, I definitely need to study that because I haven't even read the chapter yet. Business and personal deductions. Oh, man. I think I got that, but man, that's a lot. That's a lot of stuff. That is way too broad of a topic for you to put on the hints. That's not going to help me at all. I don't know, but maybe it's just like a question about business versus personal specifically, the contrast between them or something. Like-kind property, thankfully I read that yesterday. Section 41, I don't even remember what that is, but I can look that up at some point. Business interest expense deduction. Yeah, I think I got the business interest expense deduction I should be fine on that if I want to skip that one. Casualty loss. So casualty loss, I can't remember if that's a for or from AGI. I have to look that up. Short problems. 2 short problems about taxable income and tax or refund due. Parenthesis. W2, Schedule C, and Schedule E. Schedule C is business income. Schedule E is rental income. So here's the deal with those. Schedule C, business income. You can take, basically, stop. Business income. You include business income on, first of all, you calculate business income by taking like your revenue and subtract expenses on Schedule C, and then I might want to look at the tax project and see if I did anything wrong on those 2 schedules, because that could be important for the test, maybe. So I think I will. I really hope. I'm assuming that he thinks that Paul and Tina did pretty much a perfect job on this. I don't see why they wouldn't do it perfect. I don't see why he would post this if they didn't get like a perfect score on their exam. So I'm gonna see how incredibly off I was on that. So let's see here. They got the correct number there. And let's see here. Yeah, they got all the correct numbers. That's just great now, isn't it? Hey, look, I think I may have gotten the right number for the Schedule C. No, Schedule 1, sorry. I got the right number for their business income, didn't I? Wait. No, that's all you need for Schedule 1. There's nothing else. Right? And I was correct about not including rental. Hey, look at that. Was I correct about the self-employment tax? I think so. This one, okay, that's where my $500 was off. How come it's only $6,000? How come the IRA deduction is only $6,000? I don't get it. What? How? That is so confusing. Where? That is where I was off by $500. If I simply put, so my mistake was that this IRA deduction was only $6,000. What? But it said $6,500. I don't get it. It said $6,500. So why would it be $6,000? What's the deal with that? Are you kidding me? What? It says $6,500. It doesn't make any sense. What kind of limitation is there on this? What? It's not like it's limited to $6,000 or something. Like, what's going on here? What is going on? I'm going to search IRA again. It's probably only going to have one instance. Why is the IRA deduction only $6,000? What is the limitation? IRA deduction limit. Oh my gosh, it says 6,000 is the limit, but where was that? That wasn't in our textbook anywhere. Well, whatever. At least now I know. Seriously. So apparently your limit for IRA deduction is 6,000. I can't believe I never looked that up when I was... Why didn't I never... If I had looked that up, I would have gotten the right answer. Okay. So that's... I've only found one mistake so far that I've made. I think everything else is correct. Let me just look at mine. I'm going to compare them side by side and see what my mistakes were. So I found one mistake, which was the IRA deduction. So that's one single mistake so far. What about this wages or other earned income? Let's see. Wait, what on earth is this 37,000 thing? I think I made a mistake on this 37,000. I have no idea what this is. I have no idea what this is. I don't know why I put this number right here. This makes no sense. That was just a mistake in typing numbers in. Like, what the heck is wrong with me? Why would I put 37,000 right here? This is ridiculous. I don't remember doing that. So another mistake that was just a mistake in typing numbers on a sheet of paper like an idiot. I put 37,000 right here for no apparent reason. I have no idea what that was about. So that's another mistake. Compare the numbers, 193, 410. I got the correct amount of total income. And then the adjustments there is this. So that was wrong by 500. It should be 500 less than this. It should be 11,220. Nope. What the heck? No, they got 12,220. Wait. No, they got 500 more than I did. So where's the 500 more for the standard deductions here? Let's see. Let's go down to Schedule 1. Schedule 1, it looks like I got the right answer. I got the right answer for Schedule 1. And then for Schedule... And for these ones, I missed 500 here. And then there's another $1,000 missing. So let's see here. What the heck? Oh wait, never mind. So they did get 11,720. So what the heck on earth? That was funny. They had to have made a mistake because they put 12,220, but it was supposed to be 11,220. Look at this. That has to be a mistake. Wait, I'm looking at the wrong one. I'm the one who got 12,220. I keep confusing me and them. I got 12,220. They got 11,720. So anyways, standard deduction. So it turns out that they took the standard deduction here. Man, imagine if I had caught that. Just imagine. So what happened with the itemized deductions, where they couldn't take any itemized deductions because they didn't have enough? First of all, Schedule 2. So 11,440, obviously, that's all you need for that one. So I did that right. Schedule B, hey look, they also skipped Schedule 3. So at least I got that right. Schedule A? Where's Schedule A? I don't know why they have Schedule A out of order. Holy crap, they have 26 forms. 26 pages. That must mean they completed a bunch of extra forms. Where's Schedule A? Oh my gosh. Can't even find it. They did the self-employment tax form. What a fun time that is. Non-deductible IRAs. Yep, there's that. So there is a credit that I missed. Credit for qualified retirement savings contributions. I had no idea that was even a thing. Thanks a lot, Professor. Qualified business income deduction. I have no idea how this works. I thought it was supposed to be like 20% of blah, blah, blah. How come there's only $75,000 of qualified income? I don't get it. Where did they get the number 75,247? This makes absolutely no sense. What the heck? I calculated $80,000. Of income there. So I thought you were supposed to put 80,000 there. It's the calculation for their income is different for both forms. Where do they even get 75,000? Now they are limited to passive activity loss or something. This is a weird form to fill out because they didn't even include the passive loss on the schedule. Whatever schedule. Here's depreciation. So they calculated $10,545 of depreciation. Holy crap. How come there's a qualified dividends and capital gain worksheet? I can't find Schedule A anyways. Did they include Schedule A? Oh, I know why they didn't include it. It's because they didn't take itemized deductions. Well, how am I supposed to know what my mistake was in itemized deductions if they didn't include it? Are you kidding me? Man, this is just hopeless. This is just absolutely hopeless. What other mistakes are there? I don't even know. Tax. So they have other taxes. That's the only other tax. So thankfully I got that right. Then they calculated their withheld payments, right? That should be the same for both. $6,400, so $6,900. So I got this part right, thankfully. And I need to see what else I got right. They calculated Schedule B. Oh, that's fun. He said you could skip Schedule B. 568. I was correct on the Schedule B. I was correct. Well, I was correct on the number 568 for interest, right? If I go back up here. Yes, I was correct on that number. And then what else? Schedule C. I think I got Schedule C correct because I ended up with the right number at the end. So I'm not even going to look through all the other stuff. It's funny how they listed all their other expenses. Where'd you get these numbers? The mileage expense should be included on here, though. The car and truck expenses should be included on line 9. I don't know why they did this. They did depreciation expense on other expenses even instead of doing it right here. Well, not here, but I thought you would put depreciation right here. They put internet right here, and whereas I put internet under utilities. So that's fun. Capital gains, I got the right number for capital gains. And E, did I get the right number for the loss? So they got negative 2865. For Schedule E, negative 20. Nope, I got the wrong number for that. What was wrong? I put auto and travel for 6, and they didn't include that. And then for depreciation expense, they got $10,545. I got $12,000 something. Home association fee. Nope. I don't know what the heck is $39.20. I have no idea how they did this so well. It's probably because they have more experience than me doing this already. Because there's no way you could have done all this without having known what to do for all this crap. Like, what? It's not like they're geniuses. They probably just had a ton of experience doing this already, like in their internship or whatever. So what the heck am I supposed to do? I don't even know. Like, what am I even supposed to study? I have no idea. I can't even study their what they did for itemized deductions because fine, whatever. I'm just going to read through this tax project because he said there's going to be like 1 or 2 questions about just general information from the project. So, Paul and Tina Ryan lived at 3131 Ridge Street, Platteville, Wisconsin, 53818. Their social security. There's no way we have to memorize their social security numbers. That would be stupid. They live in Platteville, Wisconsin. And Paul is an engineer and also owns a rental property in Wisconsin Dells. Attributed something to AGI account. Tina operates a restaurant, Istanbul Cafe. Paul owns a house in Wisconsin Dells. Townhouse. So, we have... They donated to Doctors Without Border. They donated shares of Target Corporation to Platteville Public Library. And they donated used clothes to Goodwill. They have certain investments. They have investment to bank with Bank Cherokee, City of Platteville bonds, and General Mills corporate bond. They have also sold shares of Microsoft, Target, and Cardinal Health. So that's pretty much all I need to know. I don't know what on earth is the question. He said, like, what did he say? What did he give it as an example for a question? I can't remember. Imagine if I get it wrong. I did the project, dude. I did it. And guess what? He said all you had to do was form schedules 1, 2, 3, A, C, D, and E. And yet Paul and Tina did like a million kajillion different forms. So I don't know what else I'm supposed to memorize about this. I should be fine on that. Okay, so I did schedule C correctly, so hopefully I should just be fine on that. I don't know. Schedule E I did not do correctly somehow. I'm not sure why. But the thing is, The fact I have to memorize about Schedule E, I believe, is that if you have a rental property and you incur a loss on the rental property and you are a quote-unquote active participant, it better specify that on the test. It better specify that or I'm going to be mad. That's why. If you are an active participant, okay, so I assume that it didn't really state whether he was an active participant in the project, which was so funny. But even if he was an active participant, it doesn't matter because their AGI was too high. If your AGI is 150 or more, then you don't get any benefit. And I think like in between $100,000 of AGI and 150, your benefit of the loss, being able to deduct the loss from the rental property, is phased out. So I think that's the important thing to know about rental. Let me just look it up. That's funny. You know what's hilarious? I bet Paul and Tina have been like one of those two people have been in an internship where they do taxes for literally their job. So because how on earth could they have known how to do all that stuff? I had to do all of those forms with no experience at all whatsoever except for taking this class. How did they do that? Just how? What I'm looking for right now, I'm not gonna... Here we go, rental and royalty. Okay, but however, what if you have a loss? Oh, this is so dumb. I have to look it up in this chapter. Where's the rental stuff? Where the heck is the at-risk blah 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 blah? Where's that? Where are those limitations and stuff? Okay, I'm just gonna read the section. Whatever. Stop. Let's see, how much time do I have left? I probably have to stop at around 11:20, maybe. 11:30. I could stop at around 11:30. I don't know. I don't really have to pack all my stuff up because I'm just going to be coming back here afterwards. So I don't have to pack nearly as much stuff as normal. I have about 4 hours left before I have to go to take exams. Oh, that's hilarious. How are we supposed to apply these how are we supposed to apply these limitations if we have no freaking idea how to determine the basis? How? Here, I'll just read this. Assume that instead of investing solely in assets that generate portfolio income, use $10,000 of inheritance to acquire a 5% interest in a limited partnership. Share of the loss is $15,000. You can deduct what? The amount of cash invested is the interest? Or is the basis? Because you use $10,000 to acquire the 5% interest. I mean, that's relatively straightforward. Oh, that means that you can deduct only $10,000 because you originally spent $10,000 to buy the thingy. That was funny. Oh, geez. But this doesn't always apply to the rental property because they said there's an exception for that. Income and loss categories. Where's rental property? Rental real estate exception. It applies to active participants in rental property. You can deduct up to $25,000 of rental real estate loss against ordinary income. It phased out by 50 cents for every dollar of AGI over 100,000. Fully phased out at $150,000 of AGI. So, there. So the active participant, you must own at least 10% of it and participate in the process of making management decisions. So there, I understand that. That's fine. Like, is there anything else I need to understand about rental stuff? Like, I don't know. Because, like, it's too hard to study for this, for number 13. It's too hard to study for that. Man. Tax or refund due. And you better tell me. That is too broad of a topic, Professor. How am I supposed to study for number 13? Study the entire freaking course. That helps so much. Well, I did Schedule C on the project and got the right answer, and I did Schedule E and did not get the right answer somehow, but whatever. I just studied the rental thingy where you can deduct $25,000 of loss, except if your AGI is at $100,000, over $100,000, or if it's over $150,000. That was funny. So, What is the second most pressing thing to study right now? I guess I'll just underline it if I'm done with it. That's funny. Okay, which one? I don't know what a section 41 adjustment is. I'll just look it up. Changes in accounting methods. Oh, that's what it is. So that's actually gonna be, what the, oh my gosh. Where's section 41? Where is it? Where's the part where you talk about section 41 adjustment? There's too much information here. I don't want to do this. Change in accounting method. That would be in chapter what? That was funny. I don't remember. What chapter talked about those? That was funny. Is it in this chapter? Oh my gosh. Oh my god. No? Chapter 6? Chapter 5? I don't remember what chapter that's in. My goodness. Business income? Why would this be under business income? Oh, I found it. It's got to be here in this section. Where's section 481? Okay, we'll just read the whole section, whatever. That's fine. Actually, it's probably, after I study this, I need to study types of audits because I didn't even read that chapter. So. Oh yeah, the types of audits. We talked about that in class. I actually remember talking about that in class, so I should be fine there, but I'll still look at it just to be sure. Yay, thanks for taking 4 hours to charge my phone. No, it says it's going to take 4 hours from this current point, which it's already at 54%, and it's still going to take 4 hours. I just replugged it in and now it says 1 hour and 30 minutes. That's funny. I'm now going to do a solve. I did more than one solve. Once a business has adopted an accounting method, it must generally receive permission to change the method, regardless of whether it is a permissible or an impermissible method. There are three important exceptions to this general rule that apply to small businesses that qualify under the gross receipts test. Small businesses are allowed to switch to use the cash method, treat inventories as non-incidental materials, and ignore the UNICAP rules when the gross receipts test is satisfied. For accounting method changes unrelated to qualifying as a small business under the gross receipts test, a taxpayer must request permission to change accounting methods by filing Form 3115. Okay, so then what the heck is Form 481? Section 481. Oh, maybe it is related to Section 481 adjustment. Okay, wait. The IRS automatically approves certain types of accounting method changes, but for others, the business must provide a good business purpose for the change and pay a fee. The IRS also requires permission when a business must change from using an impermissible method. This requirement helps the IRS to certify that the business properly makes the transition to a permissible method. In essence, the IRS requires the business to report its own non-compliance. Why would a business do so? Besides complying with tax laws, a business might report its own non-compliance to receive leniency from the IRS. Without getting into details, the IRS is likely to assess fewer penalties and less interest expense for non-compliance when the business reports the non-compliance before the IRS discovers it on its own. Tax consequences of changing accounting methods. The Section 41 adjustment is actually the adjustment that you make as a result of changing methods, not the form that you use to apply for changing a method. That was funny. When a business changes from one accounting method to another, the business determines its taxable income for the year of change using the new method. Furthermore, the business must make an adjustment to taxable income that effectively represents the cumulative difference as of the beginning of the tax year between the amount of income or deductions recognized under the old accounting method and that amount that would be recognized from all prior years if the new method had been applied. This adjustment is called a Section 481 adjustment. The Section 481 adjustment prevents the duplication or omission of items of income or deduction due to a change in accounting method. If the Section 481 adjustment increases taxable income, the taxpayer generally recognizes the total adjustment spread evenly over 4 years, beginning with the year of the change. If the adjustment decreases taxable income, the taxpayer typically recognizes it entirely in the year of change. Suppose that at the end of 2022, Green Acres has $24,000 of accounts receivable. Assuming that they used the cash method of accounting in 2022, it would not include this in income determining its 2022 taxable income. Suppose that they switched to accrual method of accounting by filing a Form 3115 and receiving permission from the IRS. What is Rick's Section 41 adjustment for his change in the accounting method? His full adjustment is $24,000, which will be added to his taxable income over 4 years. Okay, so because he did not include $24,000 in receivables, in his income before, but the adjustment means that he would have included. That means so 6,000 in 20 not include payments. He has $4,000 of accounts payable at the end of the year, and then switches to at the end of 2022, $4,000 he did not include as an expense. Wait, a payable is a liability, not a. Wait a minute. He owes money. A liability doesn't decrease. What the heck? That's not $4,000 of expenses. That's a $4,000 liability. What? That is so weird. I have finished studying Section 41 adjustments. Now we will study types of audits. It's not going to be that hard. It's just going to be like 3 different types of audits. It's very easy. We have office examinations, we have correspondence examinations, office examinations, and field examinations. That's all I need. Yay! That's so easy. Oh, crap. Wait a minute. Why does the types of audits section include this? Dang it. Dang it. I don't want to read all this. No. The 3 types of IRS audits are... That was funny. The 3 types of IRS audits are correspondence, office, and field examinations. The IRS will send the taxpayer a 30-day letter which provides the taxpayer the opportunity to pay the proposed assessment or request and appeals the conference. If an agreement is not reached at appeals or the taxpayer did not pay the proposed assessment, the IRS will send the taxpayer a 90-day letter. After receiving the 90-day letter, the taxpayer may pay the tax or petition the U.S. tax court to hear the case. If the taxpayer chooses to pay the tax, the taxpayer may then request a refund of the tax and eventually sue the IRS for refund in the U.S. District Court for federal claims. I have a feeling we only need to read the part about types of audits. The correspondence examinations are the most common. These audits, as the name suggests, are conducted by mail and generally are limited to 1 or 2 items on the taxpayer's return. Of the 3 types of audits, correspondence audits are generally the narrowest in scope and the least complex. The IRS typically requests supporting documentation for one or more items on the taxpayer's return, like charitable contributions deducted, for example. When appropriate documentation is promptly supplied, these audits typically can be concluded relatively quickly. Of course, they can also be expanded to address other issues that arise as a result of the IRS's inspection of taxpayer documents. Office examinations are the second most common audit. As the name suggests, the IRS conducts them at its local office. These audits are typically broader in scope and more complex. The correspondence examination, small businesses, taxpayers operating sole proprietorships, and middle to high income individual taxpayers are more likely, if audited, to have office examinations. In these examinations, the taxpayer receives a notice that identifies the items subject to audit, requests substantiation for these items as necessary, and notifies the taxpayer of the date, time, and location of the exam. Taxpayers may attend the examination alone or with representation such as their tax advisor or attorney, or simply let their tax advisor or attorney attend on their behalf. Field examinations are the least common audit. The IRS conducts these at the taxpayer's place of business or the location where the taxpayer's books, records, and source documents are maintained. Field examinations are generally the broadest in scope and the most complex of the three audit types. They can last months to years and generally are limited to business returns and the most complex individual returns. What type of exam do you think Bill and Mercedes will have? Because their return is an individual tax return and the audit is restricted to a relatively narrow set of deductions, their return will likely be subject to a correspondence audit. If the audit were broader in scope, an office examination would be more likely. Do I have to talk about after the audit? It just says types of audits. I don't see what I need to do other than types of audits, so we'll just review this one more time. Correspondence examinations are level 1. That was fun. Correspondence examinations are over mail and only a couple of items. Office examinations are in the local IRS office. And more. And then we have field examinations is where the IRS representative goes to a place of business to conduct an examination. And it can last months to years. That's funny. So, anyways, we are now done studying types of audits. So actually, that wasn't that hard. Now what? Which one of these topics do I know the least about? Let's see. Accrual and cash methods is a very good candidate for study. That's fine. Business versus personal, definitions and conditions, casualty loss deduction, short problems. Let's do casualty loss deduction because I don't remember whether it's for or from AGI. I think it might be from AGI, so we'll look in from AGI chapter to see if that's where it is. Well, there's both for and from AGI are actually in the same chapter. Dang it. I believe it's here. Oh, actually I just saw it. It's right here. So it actually turns out that casualty and theft losses are deductions from AGI. That's funny. So, come on, where is it? And based on the thingy, So casualty and theft loss, casualty loss deduction. Look at how short of a section this is. There's a question about this random little thing here. My goodness. Okay. Individuals cannot deduct losses they realize when they sell or dispose of assets used for personal purposes. That's funny. Personal use assets as opposed to business or investment assets. Individuals cannot. Taxpayers also generally cannot deduct casualty losses. Losses arising from a sudden, unexpected, or unusual event such as a fire, storm, or shipwreck, or from theft on personal use assets unless the losses are attributable to a federally declared disaster. Dang it, I should have restarted my computer. I'm not going to restart. I'm not going to risk restarting it. It seems to be working just fine at this point, so. How many questions are there going to be on the federal income tax? Stop. So, for federally declared disasters, the casualty losses are deductible subject to a $100 floor for each casualty and a 10% of AGI floor for all casualties in a year. Wait, what is that? What does that even mean? What does it mean, floor? I think what it means is that you cannot deduct, you're only allowed to deduct casualty losses that are more than $100, and then you're only allowed to deduct casualty losses for that are more than 10% of AGI. I think that's what that means. And it's only allowed to be deducted for a federally declared disaster. You know what's hilarious? Apparently, there's more to this than meets the eye. That was funny. For business income deductions and accounting methods. So there's a casualty loss deduction for businesses, but not for individuals. For individuals, it's limited to federally declared disasters, and it's subject to a $100 floor and a 10% of AGI floor. But apparently, there's more to look at because it's business deduction for casualty. Wait, where is it? Oh, here we go. Here's business casualty losses. Oh, funny. So there's even an example problem involving casualty losses here. So businesses can incur deductible losses when their assets are stolen, damaged, or completely destroyed by a force outside the control of the business. But for me, that was funny.